Have you ever wondered who controls the money supply and economic stability in India? If you have, then let's embark on a journey to understand the Reserve Bank of India, the central banking institution of this vast nation. As the monetary authority, the Reserve Bank of India, or RBI as it's commonly known, holds the reins of the country's economic health. It is the custodian of India's monetary policy and the issuer of the Indian rupee, our national currency. Imagine it as the heartbeat of India's economy, pumping the lifeblood, money, to every corner of the country. The RBI, like a vigilant guardian, keeps a close eye on the economic trends and adjusts the flow of money accordingly. It ensures the smooth functioning of the economy, balancing inflation and growth and maintaining overall stability. Established back in 1935, the RBI, with its immense power and responsibility, plays a crucial role in India's economy. The Reserve Bank of India came into existence on the 1st of April 1935. This was a pivotal moment in India's financial history, as until then, the country's financial system was largely unorganized and fragmented. The establishment of the Reserve Bank was a direct result of the economic difficulties India faced during the early 20th century. The country was still under British colonial rule, and its economy was heavily influenced by the whims and fancies of the British Empire. The economic hardships of the Great Depression further exacerbated the situation, leading to a deepening financial crisis in India. This crisis set the stage for a comprehensive review of the Indian financial system. The British government, realizing the dire need for a regulated and structured financial system, constituted the Hilton-Young Commission in 1926. The commission was tasked with studying the financial structure in India and suggesting ways to streamline it. After an exhaustive study, the Hilton-Young Commission recommended the establishment of a central bank in India. The commission believed that a central bank would bring much-needed stability and order to the Indian financial system. It would regulate the issue of banknotes, maintain reserves to secure monetary stability, and operate the currency and credit system in the country's best interests. The British government accepted these recommendations, leading to the creation of the Reserve Bank of India in 1935. The bank was set up under the Reserve Bank of India Act 1934, and it began operations in Kolkata, which was then the most important commercial city in India. However, the RBI was not a government entity at inception. It was a privately owned institution with its shares held by private individuals. This was a common practice in many countries at the time, where central banks often started as private entities. The RBI continued as a private entity for the next 14 years. However, in 1949, post-independence and in the wake of the need for a more controlled and secure economy, the Indian government nationalized the RBI. The RBI was initially a privately owned institution, but was nationalized in 1949. RBI functions through a robust organizational structure. The backbone of the Reserve Bank of India is its central board of directors, comprised of official and non-official directors. The official directors include the governor and not more than 4 deputy governors, and let's not forget the non-official directors nominated by the government who bring diverse expertise to the table. Let's bring the regional branches into focus. The RBI has 20 regional offices, most of them in state capitals, and even has representation in 9 sub-offices. This wide reach allows the RBI to keep a finger on the pulse of the financial health of the entire country. The structure of the RBI, while elaborate, is designed with a clear purpose. From the governor at the helm to the regional branches scattered across the nation, each cog in the machine works in tandem to achieve their goal. Despite its complex structure, the RBI's mission is simple: to ensure monetary stability. The RBI wears many hats when it comes to managing India's economy. Picture the Reserve Bank of India as a multitasking maestro, orchestrating the symphony of economic stability in one of the world's fastest-growing economies. Let's begin with monetary policy. Think of it as the conductor's baton, guiding the tempo of the economy. The RBI sets the rhythm by controlling interest rates and influencing the availability and cost of credit. It's a delicate balancing act, ensuring that neither inflation gets out of tune nor growth lags behind. Next, let's talk about currency issuance. The RBI is the sole body entrusted with the responsibility of issuing currency in India. It's a crucial role that helps to maintain the public's trust in the nation's currency, ensuring it remains a reliable medium of exchange. Just imagine the chaos if this trust were to falter. Moving on, we come to foreign exchange management. India, like any other country, engages in financial transactions with the rest of the world. The RBI manages these foreign exchange reserves, a role that includes regulating the exchange rates to facilitate smooth trade and maintaining adequate reserve levels to meet any external shocks. Now let's discuss financial supervision. Ever wondered who watches over the banks? That's right, it's the RBI again. As the supervisor, it ensures that financial institutions are playing by the rules, maintaining a safe and sound financial system. From licensing banks to conducting inspections, the RBI makes sure our financial institutions are on the straight and narrow. So you see, the RBI is like the captain of a ship, steering the Indian economy through calm and turbulent waters alike. It's a role that requires foresight, precision, and a steady hand. The RBI's functions are vital to maintaining India's economic stability. From setting monetary policy to issuing currency, managing foreign exchange, and supervising financial institutions, the Reserve Bank of India plays a pivotal role in keeping India's economic heartbeat strong and steady. The RBI uses various tools to control the money supply and credit in the economy. You see, it's like a maestro conducting a symphony. The Reserve Bank of India, or RBI, wields a set of instruments to fine-tune the performance of the economy. Let's start with open market operations, a classic instrument. It's as simple as buying and selling government securities. When the RBI buys these securities, it injects money into the banking system, thereby increasing the money supply. Conversely, selling these securities reduces the money supply. Next up, we have the cash reserve ratio, or CRR. This is the minimum fraction of total deposits that banks must hold as reserves with the RBI. If the RBI increases the CRR, banks have less money to lend and the money supply shrinks. Moving on, we come to the statutory liquidity ratio, or SLR. This is the minimum percentage of deposits that banks must maintain in the form of liquid assets. Think of it as a safety net. A higher SLR means banks have less money to lend, again reducing the money supply. Finally, let's talk about the repo rate. This is the rate at which the RBI lends money to commercial banks. If the repo rate goes up, borrowing becomes more expensive for banks and they lend less. This, in turn, decreases the money supply. But why does the RBI do all this? The answer lies in its mission to manage inflation and stabilize the economy. By controlling the money supply, the RBI can influence price levels and keep inflation in check. At the same time, these measures help maintain financial stability by ensuring that banks have sufficient reserves and are not overextended. In the grand scheme of things, these instruments are the RBI's baton, guiding the tempo of our economy and ensuring that it plays a harmonious tune. So, the next time you think about the economy, remember the maestro at work. The RBI, using its instruments of monetary and credit control to keep the symphony of our economy in perfect harmony. These instruments help the RBI manage inflation and stabilize the economy. In today's globalized world, the RBI's role is more important than ever. As we navigate the complexities of the 21st century, the Reserve Bank of India grapples with challenges both old and new. Inflation, economic stability, and sustainable growth remain as pressing issues as ever. However, today's economy also presents fresh trials. With the advent of digital currencies and the evolving nature of financial technology, the RBI must adapt quickly to maintain control over monetary policy. Another challenge that looms large is the global economic uncertainty. The RBI plays a crucial role in mitigating the impact of global economic fluctuations on India's economy. It's a balancing act of managing internal economic health while keeping an eye on the global economic pulse. Let's not forget the issue of financial inclusion. The RBI is striving to ensure that the benefits of economic growth and stability reach every corner of India. The Reserve Bank of India continues to play a pivotal role in shaping India's economic future. The Reserve Bank of India, a marvel of economic management and control. Over the course of this discussion, we've journeyed through the establishment of the RBI, its structure and organization, and the myriad functions it performs. From being the custodian of India's foreign reserves to regulating the country's money supply, the RBI has been instrumental in shaping the economic landscape of the nation. we delved into the various instruments of monetary and credit control that the RBI employs. These tools, from bank rate policy to open market operations, play a pivotal role in maintaining financial stability and ensuring sustainable economic growth. The RBI's role in today's economy is more crucial than ever as it navigates the complexities of modern financial markets. From its inception in 1935 to its modern-day functions, the RBI remains an indispensable part of India's economic landscape. It continues to steer the Indian economy towards a prosperous future, balancing growth and stability with finesse and expertise.